Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberley Dondo, and in today's episode, I'm joined by Oli Brown, Investment Director at RC Brown Investment Management. Thank you for joining me today, Oli.
Thank you for having me. Nice to be with you, Kimberley.
So could you give us a bit of a background into yourself and how you got started in the industry?
Yes. So, look, I've always been interested in stocks and shares. Got into it from an early age, from probably around about 16. I guess you could say there is that in the family, investment in the family. And at university, I did in money banking and finance, then trained as an accountant, qualified as an accountant in London, then started working for RC Brown in 2006 now, so I've been here quite a long time and seen quite a lot of things.
Yeah, wow. You're kind of one of the exceptions where you actually knew what you wanted to do. A lot of people tend to say they just tripped and fell into financial services.
Yeah, that's fair. I have a sister who's a teacher, so I would argue there is some variety, at least in the family. But yes, I think I was always pretty clear on what I wanted to go into and wanted to read economics. Really interested in.
Yeah. So looking at the market, the UK market, we've seen some positive signs recently. So can you tell us about why you believe we're entering a prime period for investment in UK companies, particularly through IPOs and fundraising?
Yes, so you're right. We have had a pretty quiet couple of years in terms of equity fundraisings on the UK market. Just for example, over 2022 and 2023, we saw under £10 billion raised in each of those years, which is really low compared to the COVID years of 2020 and 2021, where you saw over £30 billion raised. So we have had a period of real quietness, shall we say, a market, but we are seeing signs of pick up this year. We have had a couple of IPOs recently that have floated, Raspberry Pi and IoT, that we have invested in both of them, but also existing listed companies been raising money, the likes of National Grid, which raised $7 billion. So there's no doubt that we'll go above the raises of 2022 and 2023, because we'll go well above the 10 billion, because 7 billion, and that was National Grid fund and invest the fund the development really of its electricity fund the development of its electricity grids. And we've also seen Great Portland Estate has raised £350. That's a property company, very London focused, and they believe that the property market is turning, and lower interest rate environment that we're expecting to see over the coming months and years, they actually think raise money for new investments. What we've seen is private equity. A lot of businesses that get floated, not all, but a lot of businesses that get floated have some private equity involvement, and their holding periods tend to be 5, 6, 7 years. Now, actually, that period's been extended because you've had COVID and had the war in Ukraine, cost of living crisis, higher rates. So there's been an awful lot has been thrown at equity markets and the economy over the last few years. And actually, really, the market's not been that open to be able to sort of take new businesses, accept new businesses.
Yeah. And The stock market was originally designed to facilitate growth for companies. How does this renewed focus on raising capital in the UK align with the fundamental purpose of the stock market?
You're absolutely right. Stock market exists for principally for companies to be able to raise money so that they can expand, so that they can invest, and that is very healthy for a healthy stock market is and it's both growth prospects, and we certainly want to see UK companies float in the UK and be backed by UK investors. And it is very important that we see an increase in the outlook for investing in the UK going forward. So yes, it is important. There is a greater focus on UK equity markets and how we get them raising their profile again and get them functioning and being just, frankly, seeing London as open for business. And there are some proposed reforms that are due to come in to make London more competitive. The likes of abolishing this premium listing structure that we have at the moment. So you have standard listing and premium listings. If you only have a standard listing, you then don't go into the indices, so therefore you don't attract a buyer. So they're gonna stop that. So if you are listed in London, then you will. There's also talk about lowering the free float requirement as well. Because sometimes you have an entrepreneur who doesn't want to give away 25 or 30% of his company at the outset. He may, but the plans are to reduce that free float, perhaps to 10%. And also at the moment, there's also the dual class voting, which they're planning to introduce, which will allow an entrepreneur or a founder of the business to upload their business, but still maintain some control over the voting shares that they hold. So that may help. It's something that's very common in the US and doesn't seem to be done to any great detriment. Remuneration is important, and there's a lot's been spoken about that. With top executives in the US do get paid an awful lot more, and the argument is that if you are chief executive of a big listed UK company, then actually trying to attract the best people is difficult because the remuneration is so much higher in the US, even if the company is of a similar size. So we have started to see some of the larger companies, the likes of Smith & Nephew and London Stock Exchange, and there have been a few others as well, that have, even though shareholders have been a bit nervous about it, have said, look, we do need to pay our top executives more, we need to remunerate them more. But it's obviously all going to be based on their ability to grow the company and the share price. So it will be linked to that. Just to add a couple more things, we've got the British ISA as well, that again is likely to be introduced at the next tax year, that will allow an extra £5,000 for investors. And this, not a silver bullet, but it's certainly useful because it will be some extra money that going into the UK market. So, it's an extra flow. We don't know how much yet, but it will be, billions.
So you're known for your expertise in the AIM market. So why do you believe the AIM market is poised for strong growth, and how can advisors help their clients capitalize on this potential rebound?
Yes, so we've kind of just sort of spoken of some of the difficulties that have been facing the London market. That certainly there has been competition from other exchanges, New York and some European ones. But we actually believe that the AIM market is something of a sort of jewel in the crown in Europe. It is an exchange for smaller companies, growth companies, where they can raise money and allow them to grow and raise money more easily. And if I was sort of speaking to an advisor, I'd encourage them to have a look at the AIM market. The valuations are historically cheap as we stand now. There are plenty of companies on the AIM market that are actually growing nicely, and they're on modest, sometimes even single-digit price earnings ratios. And what we've seen in the UK market in particular, especially small and mid caps, is we've seen this sort of drip effect of forced sellers. We've seen small cap fund managers have had to meet redemptions from their funds. They've been forced sellers of small and mid caps in particular. And anecdotally, the evidence is that that's starting to turn as the redemptions come to an end. And it won't take an awful lot to get the AIM market in particular sort of going upwards just on inflows, because it isn't. It is not the most liquid market. So, speaking with advisors, it is for clients who've got a higher risk tolerance, certainly.
Mm-hmm. And could you elaborate on the lesser known benefits of investing in AIM, particularly regarding business relief and inheritance tax planning?
Yes. So if an investor holds a AIM portfolio that consists of business relief qualifying stocks, they hold that for at least 2 years, then upon their death, it will qualify for 100% business relief, which effectively means that there'll be no inheritance tax under current legislation, which is 40%. There'll be no inheritance tax to pay on that portfolio. So it is obviously a potentially useful tool for advisors with their clients. Those who have potential inheritance tax liabilities, that they invest part of their wealth in an AIM service. It's quite popular, we find, with people who've got ISAs and put AIM stocks, ISAs. So you do have people who over the years they've subscribed and they now have either 6 or even 7-figure ISA portfolios that they actually have no great need or use for that money, likely to be passed to their beneficiaries on their death. But at least it allows them to keep control of the assets, and certainly within an ISA, they are still able to take the income if they want from the portfolio, which is tax-free, and also there's capital growth as well. We would expect it to be capital growth over the longer term.
Yeah. And what are the key considerations when constructing an AIM portfolio for inheritance tax planning?
Yeah, so we look to build a portfolio of 30 to 40 stocks that's across different sectors. And actually, the AIM market is quite different in the makeup compared to, say, the FTSE 100, which tends to have a lot of so-called old economy stocks, so banks and the large miners and oil. Whereas the AIM market, yes, it does have some small cap oil and miners, which we actually tend to avoid investing in, but there is a much larger focus on sectors such as healthcare and technology, which might be considered more sort of newer economy stocks, and often are the ones that are growing well. So we like to select a well-balanced portfolio of companies that are largely profitable and have an ability to pay a dividend. Not all of them pay a dividend because some companies believe that it is best to keep the money in the business and use that money to grow. But a large percentage of our it does actually pay some form of dividend.
Mm-hmm. And focusing a little bit more on financial advisors, how can advisors play a role in educating their clients about the opportunities available in the UK market, especially on AIM?
And I think an advisor's role is to educate and maybe remind clients that there are some good companies in London and the AIM market. Small caps have been overlooked for so many years now, and ultimately, from from acorns grow trees and oak trees. There is potential on the AIM market. There is real growth prospects on the AIM market, and actually now could be a good time to have a look because valuations are low. In the falling interest rate environment that we're expecting to see over the coming months and years, would expect the AIM market to perform pretty well. And remember the AIM market is currently trading more than 30% below its highs of 2021. So there's a lot of catch up relative to other markets potentially to take place.
Mm-hmm. Are there any key conversations that advisors should be having with their clients right now?
In relation to?
Yeah, in relation to what's available in the UK market and AIM.
Yes, so it is certainly an AIM market. You could do two things. There may be clients who've got quite a high sort of risk tolerance, who may just be very interested in investing in smaller companies. So they could invest in an AIM portfolio because they're prepared to take extra risk with the hope of getting greater return. There's also the inheritance tax angle that we spoke about. Again, most AIM companies qualify for business relief. Again, it's important that an advisor speaks with their client and the client accepts that there is a high risk profile in these sort of portfolios because they're relatively concentrated, they're smaller companies. Yes, there's the ability for significant gains, but there is also the ability, for volatility. We have seen some sharp drawdowns over the years in the AIM market. So an advisor needs to be confident and comfortable that its client can sort of cope with the fluctuations and focus on the longer term. This should be seen as a longer term investment, 5, 10 plus time horizon. And actually what clients can do, and we see quite a bit of this, is clients start with a smaller investment in AIM. Maybe they use their ISA allowance, about £20,000, and they started with that. And that can be a good way of just dipping toe into the market and getting comfort with what we're doing and around the AIM market as well.
Mm-hmm. So which types of clients are most suited for AIM investments, and how can advisors assess their clients' risk tolerance and investment objectives in this context? I know that we did talk about probably it's more suited for those who with a higher risk tolerance, especially if they're investing in smaller UK companies. But is there anything else that can be considered?
Yes, obviously the most important thing I would say is understanding the risk profile of the individual, and different people are different. Some people if they see their portfolios fall by 20%, that's the sort of thing that keeps them awake at night and gets them very concerned. Then I would argue that this would not be a suitable product for them. But if they're a client who understands the risk, perhaps has run their own business before and understands the ups and downs that you do see in business, then those sort of people, I think this sort of product is suitable for. But ultimately, it is for clients who've got a higher risk tolerance and an inheritance tax, potential inheritance tax liability. Because actually, if they do nothing, then they will lose 40% of their assets, or 40% over the thresholds, which for some people, for wealthier clients, who may be worth in excess of £1 million and £2 million, that can be quite a lot of money. So in many ways, actually the risk is reduced because you're going to lose 40%. Whereas if you invest in a sort of an AIM inheritance tax portfolio, should do better than minus 40%. And actually over the long term, there's prospects for reasonable growth as well.
Mm-hmm. Yeah. I think also like a lot of people say that for those clients who might look at their portfolios and see like a 20% dip, you're not I've been told you're not meant to look at that stuff on like a daily basis, for example, because you will get terrified. It's something that's meant to be long term. You're meant to maybe do a yearly or every 6 months check in, but it shouldn't be something regular, right?
Yeah, I'd agree with that. Looking at your portfolio every day, obviously, clients have online access these days, and they're very welcome to do that. But we ultimately, I see them paying us to construct their portfolio and, frankly, do their worrying for them, because we do look at it every day. We look at the news flow every day. Involved that we hold and other companies on the AIM market. So we wouldn't encourage someone to look at their portfolio every day, but of course, if they want to, then they're very welcome to. But there are fluctuations, and the fluctuations are greater on the AIM market. Every 6 or 12 months, just to see how the portfolio is doing is very sensible. We send an update every quarter, updating on what's gone on in that quarter.
Yeah, I think that's a clearer picture, doing it every quarter. But thank you for speaking with me today, Oli. This was a very interesting conversation.
Not at all. Thank you very much for having me.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.